Welcome to StudyVix YouTube channel, where we always study smart and master your future. Today, we are initiating a crucial audio lecture focusing entirely on Chapter 8 of Corporate and Other Laws, the Declaration and Payment of Dividend. This subject is, well, it's non-negotiable for your CA and our corporate compliance understanding. It deeply affects shareholder rights and, of course, management accountability.
Indeed. And our mission here is to move far beyond just simple memorization. We are going to conduct a thorough analysis and synthesis of sections 123 to 127 of the Companies Act 2013. We'll examine the financial rationale, the strict legal conditions, and the final custodial framework provided by the Investor Education and Protection Fund, or IEPF. This is all about gaining quick but, thorough mastery, understanding not just what the law says, but why it says it.
Okay, let's start at the very beginning then.
Yeah.
For the benefit of everyone listening, what is the statutory definition of a dividend, and what is its fundamental nature in corporate finance?
Legally, the definition is crisp. It's encapsulated in Section 235 of the Companies Act 2013. It simply states that dividend includes any interim dividend.
That's it, just that one line.
That's the legal text. But conceptually, you're right, it's much more significant. It represents an apportionment of the net distributable profits of the company to its shareholders. It's really the primary way a shareholder gets a tangible return on their investment when a company has earned revenue profits.
And this leads directly to one of the most common early confusions for a student, I think, the basis of the calculation. When a company declares, say, a 50% dividend, where is that percentage actually applied?
This is a point of crucial distinction. You have the commercial reality of the stock market on one hand and the legal reality of company accounting on the other. The market price of a share, which might be, 500 or 1,000 rupees, is driven by demand, speculation, future earnings.
All that market sentiment.
Exactly. But the dividend declaration is entirely blind to that figure.
So if a company has had spectacular market growth, the dividend calculation just doesn't factor that in at all.
Absolutely not. The fundamental rule for declaration dictates that dividend is declared strictly as a proportion of the nominal or face value, the FV, of a share. Never the market price.
The face value?
The face value. It's the foundational statutory value of the share as it's recorded in the Memorandum of Association. This stability is critical because the dividend distribution has to relate back to the capital base, not the fluctuating sentiment of the trading floor.
Let's make this calculation concrete. Let's use AB Limited. The company has equity shares with a face value of 10 rupees per share. But those shares are trading robustly at, say, 250 rupees per share. If the board declares a 20% dividend at the AGM, what happens?
The calculation has to ignore the 250 rupee market price completely. We strictly apply the 20% to the face value of 10 rupees. So the dividend per share is 20% of 10 rupees, which results in 2 rupees per share. This calculation is a legal mandate. It's designed to ensure uniformity.
Right. It prevents the chaos that would happen if the market price, which changes constantly, was the basis.
Exactly. And if Mr. Shikhar owns 1,000 shares, and maybe he purchased them at a premium, perhaps 300 rupees per share, that purchase price is irrelevant for this.
So his capital outlay is for his own books, not for the dividend calculation.
Precisely. His capital outlay determines his potential capital gains or losses, but it doesn't influence his dividend income. He receives 1,000 shares multiplied by that fixed, legally calculated dividend of 2 rupees per share. That's it. This distinction is, it's the first cornerstone you have to grasp in dividend law.
Okay, moving from the calculation to the authority. Who ultimately decides the rate of the final dividend? It seems like a classic corporate tension, between the management, the board, and the owners, the shareholders.
It is a critical balance of power, and it's enshrined in the Act to promote financial prudence. The power to declare the final dividend is vested in the members. They exercise it via an ordinary resolution passed at the annual general meeting, the AGM. The shareholders are the ultimate owners, so it makes sense that they must approve the payout.
But their power isn't absolute, is it? They can't just demand a huge payout if the board has recommended something lower.
That is the essential legal constraint, and it acts as a very important safeguard. The law clearly states that the rate of dividend declared by the members at the AGM cannot be higher than the rate recommended by the board of directors.
Why is the law so distrustful of shareholder enthusiasm here? If the shareholders own the company and they collectively feel confident enough to withdraw more capital, what's the legal principle stopping that?
It's rooted in the principle of capital maintenance and, crucially, creditor protection. The board has intimate knowledge of the company's forward-looking liquidity needs, capital expenditure plans, potential contingent liabilities.
The day-to-day realities of running the business.
Right. If shareholders, maybe driven by short-term gain, were allowed to increase the payout against the board's better judgment, it could severely damage the company's solvency. It could jeopardize future projects, and most importantly, it would impair the capital cushion available to creditors. So the board's recommendation sets the ceiling. Members can agree, or they can approve, a lower, more prudent rate, but they can never, ever increase it.
Let's differentiate based on timing. We have the standard final dividend we've been talking about, and then there's the interim dividend. What truly distinguishes these two from a compliance and accounting perspective?
The distinction is primarily rooted in the finalization of the company's accounts. The final dividend is recommended by the board and approved by the shareholders after the close of the financial year. After the full financial statements are done, the audit, the tax assessments, it's a finalized distribution based on verified annual performance.
And the interim dividend, on the other hand, is declared midstream.
Exactly. It's declared and paid during an accounting year, before the finalization of the annual accounts. It's essentially announced between two AGMs, reflecting profits earned during, say, a half-year or quarterly period. And this means its declaration is an act of the board of directors alone. Shareholder approval is not required at the time of declaration.
I see. And this interim nature must affect the sources of profit that are available. Where does the law permit an interim dividend to be drawn from?
The sources are defined broadly, but, carefully. It reflects the preliminary nature of the whole thing. An interim dividend can be paid out of 1. The surplus of the profit and loss account, 2. The profits generated in the current financial year up to the date of declaration, or 3, and this is crucial, the profits generated in the current year till the quarter preceding the date of declaration. This allows for rapid, timely distribution.
What if the board declares an interim dividend, but later in the year the company suffers a catastrophic loss? Can they stop the payout? This is where revocability comes in, I suppose.
Revocability is the ultimate differentiator here. It highlights the difference in finality. Once the final dividend is approved by shareholders at the AGM, it instantly transforms into a legally recognized debt owed by the company to its members. At that point, it cannot be revoked. The company is irrevocably bound to pay.
But the interim dividend is still preliminary.
Right. Since the interim dividend is declared solely by the board and before the final closing of accounts, the board can revoke it. But, and this is big but, only if they secure the explicit unanimous consent of all shareholders. Without that unanimous consent, once announced, the dividend has to be paid.
Okay, finally, within the capital structure, the nature of the shares determines the priority of payment. Let's look at the legal hierarchy between preference shares and equity shares.
Section 43 establishes this hierarchy. Holders of preference shares are afforded a preferential dividend right. They're typically assured a fixed rate of dividend, and their claim must be satisfied in full before any funds are distributed to equity shareholders.
And the most important nuance within preference shares is that distinction between cumulative and non-cumulative. This is critical for assessing historical liability.
Absolutely. Cumulative preference shares offer a powerful safeguard for investors. If the company has insufficient profits in a given year and can't pay the fixed preference dividend, that unpaid amount, the arrear, it accumulates. The core principle is that these accumulated arrears must be paid in full, every single penny, in subsequent profitable years before the company can declare any dividend, however small, on its equity shares.
So if a company skips the cumulative preference dividend for 5 years because of losses, they'd have to pay 6 years' worth, the 5 arrears plus the current years, before equity shareholders see a dime.
That is the mandatory operational mechanism. Now, contrast this with non-cumulative preference shares. Here, the dividend is a contingent right. It's payable only when the company earns sufficient profits and declares a dividend in that specific year. If the company doesn't declare a dividend, the right to that year's payment simply lapses forever. There are no arrears. It's a use it or lose it situation.
And the equity shares, representing the ultimate risk takers, they get their dividend only after all prior claims are met. They're the residual claimants.
That's right. They get what's left.
This transitions us perfectly into compliance. We have to rigorously define where dividend funds can come from. Here's where we get into mandatory compliance and critical restrictions. Where can the dividend money legitimately come from? And more importantly, what funds are strictly off limits?
The foundational principle of modern corporate law, developed over centuries, is the doctrine of capital maintenance. It's all about protecting creditors. Dividend, by its very nature, has to be declared out of revenue profits, not capital. The cardinal rule is absolute. Declaring a dividend out of capital is strictly prohibited because it diminishes the cushion available to cover corporate debts.
This links directly to the idea of asset wear and tear, right? If a company distributes all its cash profits without accounting for the fact that its machines are getting older, isn't it just giving away its capital?
That is precisely the commercial and legal implication. The law recognizes that failing to provide for depreciation, that notional estimate for the reduction in asset value, is tantamount to inflating your distributable profits. If the company pays a dividend based on those inflated profits, it is in effect drawing that dividend out of capital, and that's prohibited.
Let's delve into this mandatory provision for depreciation then. It's often seen as just an accounting entry, but legally, it's a financial gatekeeper.
It is a critical safeguard. Depreciation is the systematic reduction in the cost of a fixed asset over its useful life. The law, specifically referencing the method in Schedule 2 of the Companies Act, mandates the provision for depreciation out of profits before a company can declare any dividend.
So why is it so mandatory? What are the severe consequences if management tries to bypass this?
The consequences are severe on two fronts: financial transparency and legal compliance. First, if depreciation isn't provided, the asset value stays overstated on the balance sheet. This presents a misleading and, frankly, unhealthy financial picture to all stakeholders.
To investors, creditors, everyone.
Everyone. Second, and most critically from a legal standpoint, the failure to deduct depreciation means you're paying out profits that should have been kept inside the company to maintain the assets. So in the eyes of the law, the company would have declared dividend out of capital, which triggers the stringent penalties of Section 123.
Okay, so dividend distribution also depends heavily on the definition of free reserves. Section 243 defines them as reserves available for distribution. But the law is very specific about excluding paper profits. What are these critical exclusions?
This is where we ensure only tangible, realized wealth gets distributed. The law explicitly prohibits using funds that represent, potential or conceptual increases in value. The exclusions are very precise. First, any amount representing unrealized gains, notional gains, or revaluation of assets. These gains are not cash in hand.
Right, they're just an entry on a ledger.
Exactly. And second, any change in the carrying amount of an asset or liability that's recognized directly in equity. For example, a surplus that arises just from a fair value measurement exercise.
This prevents a common pitfall. Let's look at Shreyas Mechanics Limited. They revalue their land, which instantly creates a non-cash revaluation profit of 20 lakh rupees. They also have legitimate, realized, free reserves of 24 lakh rupees. Can the board use the full 44 lakh for a dividend?
The board cannot legally touch that 20 lakh rupees. That figure is a notional gain. If they were to pay a dividend using that revaluation surplus, they'd be distributing money they haven't actually earned or monetized through a sale. So they are legally restricted to declaring a dividend only from the 24 lakh rupees of realized free reserves. This protects liquidity.
We've talked a lot about mandatory provisions, but the Act does offer some flexibility in retaining profits. Is there a mandatory minimum percentage a company must transfer to its reserves before it can declare a dividend?
This is a crucial clarification, especially for those familiar with older legal frameworks. Under the Companies Act 2013, that requirement for a mandatory minimum transfer, it's been removed. The transfer of profits to reserves for any financial year is left entirely to the discretion of the company's board of directors.
So management has full freedom here. They can choose to transfer 1% or 99%.
Exactly. A company is free to transfer any portion it deems prudent, or if the board decides that maximizing shareholder payout is necessary, they may choose not to transfer any amount at all.
The Alma Watches Limited case seems to confirm this. They propose to transfer more than 10% of their profits to reserves before declaring a 12% dividend. It's perfectly fine then.
It is entirely valid. The law fully supports that internal decision. The discretion to retain funds is absolute, reinforcing the principle that management is best positioned to assess the company's financial future.
All right, this brings us to a really high-stakes compliance area.
Yes. We now enter one of the most technical and critical areas, declaring a dividend when the current year's profits are insufficient or even zero. This decision to draw upon accumulated profits or reserves is high risk, and so it's subject to the extremely rigorous safeguards in Rule 3 of the Dividend Rules, 2014, and a company must satisfy all 4 of these specific conditions at the same time.
The purpose seems clear. prevent companies from masking failure by just emptying their historical savings. So let's unpack the first condition, which governs the rate of the payout.
Right. It imposes a ceiling based on demonstrated financial stability. The rate of dividend declared for the current year, when you're drawing from reserves, shall not exceed the arithmetic average of the rates at which dividend was declared in the immediately preceding 3 years.
So it's a simple formula. Rate of dividend is less than or equal to the average of the last 3 years' rates. It forces management to anchor their payout to historical stability.
Precisely. It prevents opportunistic payouts. However, there is an important relief. This condition does not apply if the company hasn't declared any dividend in each of the 3 preceding financial years. If there's no history to average, the constraint is lifted.
Well, let's apply this to Capricorn Industries. Their preceding 3 years' rates were 9%, 10%, and 12%.
Okay, so the total is 31%. Divided by 3, the average rate is 10.33%. This means the absolute maximum dividend rate Capricorn Industries can declare this year using reserves is 10.33%. Nothing more. The rate constraint is the first gatekeeper.
Okay, gatekeeper 1 is the rate. What's the second condition?
The second condition provides the liquidity control. It imposes a limit on the absolute amount that can be drawn from the accumulated profits to fund that dividend.
And what is that specific quantitative limit?
The total amount to be drawn from accumulated profits or reserves shall not exceed 10% of the sum of its paid-up share capital and free reserves, as per the latest audited financial statement.
So the amount you pull out can't be more than 10% of your total equity base. That seems designed to make sure the withdrawal doesn't severely impact the company's financial stability.
That is the core rationale. By limiting the withdrawal to just 10% of this combined figure, the law ensures the company retains a substantial majority of its core equity and reserve cushion.
Got it. Condition 3 then addresses the current year's performance. If a company is drawing from reserves, it's almost certain it made a loss in the current year. How does the law handle that?
This is a matter of priority and sequencing. The amount drawn from accumulated profits must first be utilized entirely to set off the losses incurred in the financial year in which the dividend is being declared.
So they can't just pay the dividend and leave the current loss sitting on the books.
Absolutely not. The sequence is non-negotiable. The drawn reserves must clear the current period loss. Only the remaining portion of the drawn amount, after completely wiping out the current year's loss, can then be used to declare the dividend.
That makes sense. It's about sound accounting. Okay, what's the fourth and final condition?
The final condition is perhaps the ultimate solvency test. After all that, the company must ensure it still retains a substantial reserve buffer. The law mandates that the balance of reserves after the withdrawal shall not fall below 15% of its paid-up share capital.
So this is the final safety net. A minimum equity margin must be preserved. Let's go back to Capricorn Industries. Initial free reserves were 240 lakh, paid-up capital was 200 lakh.
Okay, so we calculate the minimum buffer first. 15% of the paid-up capital, that's 200 lakh, is 30 lakh rupees. This means no matter what, the final reserve balance has to be 30 lakh or higher. In our source example, the final balance was 196 lakh, which is much greater than the 30 lakh minimum, so that condition is satisfied. But if the withdrawal caused the reserves to drop to, say, 25 lakh, the proposed dividend would be illegal. It violates condition 4.
So mastering this flow, the rate cap, the 10% withdrawal cap, the mandatory loss set-off, and the 15% minimum reserve balance, that is the entire framework.
It is. And beyond these financial constraints of Rule 3, there are also statutory prohibitions based on regulatory compliance failures.
Right. One of the most serious relates to public deposit.
Absolutely. Section 123(6) imposes a critical restriction. If a company fails to comply with the provisions for accepting or repaying public deposits, that company is prohibited from declaring any dividend on its equity shares. And that ban stays in effect as long as the failure continues. It's a massive incentive for compliance.
It certainly is. And we should also mention Section 8 companies again here.
Yes. Just to be clear, these are the charitable companies. They are explicitly prohibited from paying any dividend to their members. All profits must be applied only toward promoting their charitable objectives.
Okay, once all those declaration hurdles are cleared, we shift focus entirely to the mechanics of payment. This phase is governed by extremely strict statutory deadlines.
Yes, the law demands immediate financial security for the declared amount. Section 123(4) mandates that the dividend amount, interim or final, must be deposited in a separate bank account with a scheduled bank.
And what is the precise window for this essential segregation of funds?
The deadline is short and non-negotiable. The deposit must be made within 5 days from the date of declaration of the dividend. This ensures the dividend money is clearly earmarked, isolated from the company's general operational funds.
Using our example, if Avantika Ayurvedic Products Limited declares the dividend on September 24th, the amount must be safely deposited by September 29th, a hard 5-day deadline.
Absolutely. Though we should note the key exemption here. This rule is waived for certain government companies where the entire paid-up share capital is held by the government.
Now that the money is secure, who is the legally entitled party to receive the payment? What if the shares were bought just last week?
The dividend is payable only to the registered shareholder as per the company's register of members, or to their order, or to their banker.
The critical concept here, especially when shares are changing hands, is the record date.
The record date is the snapshot. The company sets a specific date to determine who is eligible. The individual whose name is on the register of members on that specific record date is the person legally entitled to the dividend, regardless of when they actually bought the shares.
Let's consider the East-West Limited example. Mr. Benoit transferred shares to Mr. Mohan. The dividend was declared later, with a record date of September 7th. Mr. Mohan's name was entered on the register way back on June 18th.
Since Mr. Mohan was the registered shareholder on the record date, he gets the dividend. Mr. Benoit, the previous holder, has no legal claim against the company for that dividend.
A quick note on potential conflicts with bonus issues?
Yes. While a company can issue fully paid-up bonus shares, the Act is clear on one thing. Bonus shares cannot be issued in lieu of dividend. If a cash dividend has been declared, it must be paid in cash or another approved method. You can't force a shareholder to take bonus shares instead.
The ultimate enforcement of this payment obligation rests on Section 127, which outlines some extremely steep penalties for failure to pay. What's the key deadline breach that triggers these?
The statutory payment window is rigid. The dividend must be paid or the dividend warrant posted within 30 days from the date of its declaration. Failure to meet this 30-day deadline is the fundamental breach.
And what is the immediate liability for the company?
The company has to pay simple interest at the high rate of 18% per annum for the entire period. The default continues. It's meant to compensate the shareholder and deter complacency.
And the directors face personal consequences. This moves into criminal liability.
It does. If a director is knowingly a party to the default, they are punishable with maximum imprisonment up to 2 years and a heavy minimum fine of 1,000 rupees for every single day the default continues.
This confirms that a shareholder like Mr. Ranjan can't just claim 20% interest, even if he wants to. The statutory limit is 18%.
That's correct. The penalty is prescribed by statute. The maximum claimable interest is capped at 18% per annum.
However, the law provides a few defenses, doesn't it? When is a company excused?
Yes. There are a few scenarios where the company is not at fault. For instance, if the non-payment is due to the operation of law, like a court order, or if it's due to the shareholder's own failure to comply with instructions, like giving wrong bank details. But, and this is key, provided the company communicated the non-compliance back to the shareholder.
That notification clause is key, as shown by the case of Mrs. Sheila Bhatt, whose bank returned the payment due to a surname difference.
Exactly. If the bank returns the payment, the company knows it hasn't been paid. If the company then fails to inform Mrs. Bhatt and ask for corrected instructions within that 30-day window, the company loses its defense. The penal provisions of Section 127 will apply. The burden of communication is on the company.
Okay, that brings us to the final stage. What happens after that 30-day payment period? This leads us into the architecture of the Investor Education and Protection Fund, the IEPF.
Yes, starting with the immediate follow-up. The Unpaid Dividend Account, or UDA. Any declared dividend amount that remains unpaid or unclaimed within that initial 30-day period must be transferred by the company to this separate bank account.
And what's the deadline for this UDA transfer?
The transfer to the UDA must happen within 7 days after the expiry of the initial 30-day payment period. Failure to transfer the amount within this tight 7-day window results in a separate interest penalty. The company must pay interest at 12% per annum.
That's a crucial distinction. We have the 18% penalty for failure to pay the shareholder and a 12% penalty for failure to transfer to the UDA.
Yes, the distinction reflects the nature of the default. 18% is for the initial breach of duty to the shareholder. 12% is for the administrative failure to segregate and secure the unclaimed funds. And even after funds move to the UDA, the shareholder's right to claim is preserved. They can still apply directly to the company.
How long do the funds stay in the UDA before they're deemed permanently unclaimed? This is where the crucial 7-year rule comes in.
The 7-year rule governs the transition to the final custodial stage. Any money remaining in the UDA that is unpaid or unclaimed for 7 consecutive years from the date of transfer to the UDA, that money gets transferred by the company, along with any accrued interest, to the Central Investor Education and Protection Fund.
And the stakes are high because this doesn't just apply to the cash dividend, but also to the shares themselves.
That is the most significant consequence. The law mandates that all shares, in respect of which dividend has not been paid or claimed for 7 consecutive years or more, shall also be transferred by the company into the name of the IEPF authority.
Let's clarify 7 consecutive years. If a shareholder misses the dividend in year 1 and year 2, but claims it in year 3, does the clock restart?
Yes, the clock absolutely restarts. The law requires 7 uninterrupted consecutive years. If the dividend is paid or claimed for any single year during that period, the requirement for share transfer is negated. The shares will not be transferred.
And if the shares are transferred to the IEPF authority, is the investor's ownership right permanently forfeited?
No, the right is not extinguished. The IEPF framework is a trust mechanism. A claimant whose shares have been transferred can still legally reclaim them, along with all the resulting benefits, by following the prescribed procedure.
So let's delve into the corpus itself, the IEPF. Who established this massive custodial fund?
The IEPF is established by the central government under Section 125. For its management, an authority is constituted. The Secretary of the Ministry of Corporate Affairs is the ex officio chairperson. This authority is the steward of billions of rupees in unclaimed investor funds.
And the fund's significance comes from the sheer breadth of monies it collects. It's far more than just unclaimed dividends, isn't it?
Oh, absolutely. It's a repository for almost all forms of long-term unclaimed investor money. You have the unpaid dividend, of course, but also things like unclaimed matured public deposits and debentures.
Okay.
Application money that was due for refund but never claimed. And, interestingly, monies received through disgorgement. That's the forced repayment of ill-gotten gains imposed on wrongdoers.
Wow, even disgorgement amounts.
Yes. Also, sales proceeds of fractional shares, redemption amounts of preference shares, and, of course, all the shares themselves that get transferred over. It's an extensive list.
Which solidifies its role as the final safety deposit box for all neglected investor entitlements. So how is this massive fund utilized?
Its utilization is strictly governed and must serve the public interest. First and foremost is refunds. The fund is used for refunding all those unclaimed amounts to the eligible applicants who successfully make a claim.
Okay, so direct repayment is priority 1. But it's also about systemic improvement, right?
Exactly. The second core function is the promotion of investors' education, awareness, and protection. This is a crucial public service, using funds from unclaimed accounts to benefit the wider investing public through educational campaigns and awareness initiatives. The third category is distribution. This is where those disgorged amounts, the ill-gotten gains, are distributed among the eligible victims who suffered losses. And the fourth key use is reimbursement. The IEPF can reimburse legal expenses for investors pursuing class action suits under the Act, once sanctioned by the tribunal.
So it's clear the IEPF acts as both a final custodial treasury and a proactive tool for systemic investor education and protection.
If we synthesize this entire audio lecture on sections 123 to 127, the underlying architecture is a complex, yet I think elegant balancing act. It seeks to enforce management accountability through penalties and mandatory compliance steps like depreciation and Rule 3, while also establishing a robust financial safety net for the shareholder via the IEPF framework.
So what does this all mean for you, the learner? Your mastery of this topic really requires absolute clarity on the 3 key timelines: the 5 days for depositing the declared dividend, the mandatory 30 days window for payment before that 18% penalty kicks in, and the 7 consecutive years before unclaimed funds and shares must be transferred to the IEPF authority. These deadlines are the compliance checkpoints for any corporate law professional.
They absolutely are.
And that brings us to our final thought for you to take away. We spent considerable time analyzing the 4 rigid conditions under Rule 3, which dictate how a company uses its accumulated profits. We also noted that these 4 conditions are entirely waived for wholly owned government companies. Now, given the fundamental principle that dividends should not be paid out of capital to protect creditors, why do you think the legislature provides this specific sweeping exemption for government companies? Does the sovereign guarantee completely override the requirement for capital maintenance prudence? Consider the differing risk profiles and legislative intent when ownership rests entirely with the state. Thank you for joining this comprehensive audio lecture on StudyVix. Always study smart and master your future.
Don't forget to like and subscribe.